Welcome back to the deep dive. Today, we're digging into a pretty significant market move that happened over the last day or so. Our mission really is to figure out what drove this decisive shift, because it definitely put an end to that period of indecision we were seeing last week. And the big headline, Bitcoin, it resolved upwards pretty emphatically, actually, spiked about 4% to get back over $106,000. Now, this wasn't just random. Sources are pointing to a dual catalyst rebound, part technical, part macro. But, and this is the catch, it looks like it's climbing what we're calling a wall of worry. Oh, okay, so let's unpack this. We need to understand the catalyst, definitely, but maybe more importantly, why does the underlying data seem, fragile? What's going on beneath the surface?
It really has been a defining 24 hours.
Yeah.
Let's start with the technical side, because that really set the stage. The market was trading under quite a bit of pressure heading into the weekend. But we got a really successful weekly candle close. Price held decisively above $104,500.
Right, that level we talked about.
Yeah.
Why was holding that specific level so important again?
Well, it validated the 50-week Exponential Moving Average, the EMA. That was basically the line in the sand, the make-or-break support floor everyone was watching. This isn't just some arbitrary line. It's a key long-term indicator, used in traditional finance too. Holding it just instantly wiped out the most immediate bearish predictions.
Okay, so the chart watchers were breathing a sigh of relief. But that technical base needed fuel, right? And it got it from a big macro shift. We've been talking for weeks about the U.S. government shutdown fears kind of sucking the air out of the room for risk assets. That just reversed.
Exactly. That whole risk-off cloud just dissipated.
Huh.
The key was political action. The U.S. Senate pushed forward a procedural vote, 60-40. It basically signaled a clear path to ending the shutdown very soon. And that single piece of news, it triggered a broad risk-on rally. Bitcoin was right there, catching the bid immediately.
It's fascinating how quickly everything moved in sync. You saw U.S. equity futures like the NASDAQ jump 1.25%, maybe 1.5%.
Yeah, and global indices opened higher too.
Does that just cement the idea that Bitcoin is acting like a super sensitive barometer for global liquidity now, like a high beta play on risk?
It absolutely validates that link, yes. It seems Bitcoin is trading almost purely on global liquidity conditions right now.
Yeah.
When it looks like the taps might turn back on or even just stop seizing up, Bitcoin responds. And you saw that sentiment shift reflected immediately in the fear and greed index. It was down to 22, extreme fear.
Yeah.
It popped up to 29. Still in fear, mind you, so skepticism is definitely still high. But that intense, immediate selling pressure, it eased off.
Okay, now here's where it gets really interesting for me. The central contradiction, this wall of worry. We see this price spike, looks strong on the surface. But then you look at the flows, particularly the institutional money through the ETFs, and they were heading for the exit, big time. Last week was apparently one of the heaviest outflow weeks ever for the spot Bitcoin ETFs, something like $1.2 billion out.
That's the figure, around $1.2 billion. And yes, that creates this powerful divergence. That's why we need to be cautious. All that institutional selling pressure, it was just absorbed, but by a totally different group. The data suggests it was very aggressive. Spot buyers think sharks and retail traders stepping in.
So the institutions were selling, but retail and maybe some mid-size holders just bought it all up.
Pretty much. In the short term, it makes the ETF flows look like a lagging indicator, not predictive of the immediate price action.
Which raises the question, if this rally runs out of steam, who's left holding potentially overpriced coins?
Exactly. And that leads us straight into the on-chain data, the structural fragility piece. Because that data shows precisely who's selling, who's buying, and crucially, why those buyers might be on shaky ground.
Okay, lay it out for us. What are the warnings?
Right, so several things. First, the veterans. Long-term holders, people holding for, say, over 155 days, they're actually increasing their selling, taking profit into this rally.
They see it as an exit opportunity, basically.
Seems like it. At the same time, what we call aggregate apparent demand, that's the fresh capital coming in from new buyers, it's actually contracted significantly. It's in the red zone.
Meaning not enough new money is flowing in to easily absorb what the long-term guys are selling?
Precisely. There's an imbalance there. And the third piece is the short-term holders, the STHs. This cohort is looking particularly vulnerable right now. There's a metric called STH-NUPL. Bit technical, but what it means in simple terms is that this group, the recent buyers, are on average sitting on about a 10% unrealized loss.
Ouch. So they bought higher, and now they're underwater by 10%.
On average, yes. Which means if the market even hiccups, these are the investors most likely to panic sell to cut their losses. They fueled the recent buying, but they're fragile.
Okay, so summing up the price action, it looks healthy because it's spot-driven real money buying, not just leverage.
Correct, not derivatives driven in the same way some past rallies were.
But it's fragile because that spot demand seems to be drying up just as the experienced holders are cashing out. Is that fair?
That's a perfect summary. It's this unstable equilibrium that really defines the moment.
Okay, let's pivot slightly. Because while all this price drama is unfolding, there were actually two pretty big structural developments today, November 10th. That signal maybe a longer-term maturation for the whole crypto market, moving it closer to traditional finance.
Yeah, significant news on the regulatory and market structure front.
First up, here in the U.S., Cboe Global Markets launched something new today, continuous futures for Bitcoin and Ether. Now, these are CFTC-regulated, cash-settled, which is standard. But the interesting bit is they have a 10-year expiration designed to sort of mimic perpetual futures using a funding rate.
That's right. And it's a really critical development for U.S. market structure. What it does is create an institutional-grade, regulated alternative to the offshore perpetual swap market.
Which is massive, but operates in a kind of regulatory gray area, right?
Exactly. So this Cboe product potentially de-risks derivatives, trading for big regulated U.S. institutions that might have been hesitant to use the offshore venues. It brings more activity onshore under regulatory oversight.
Okay, interesting. But the regulatory action wasn't just in the U.S. We saw something potentially quite profound from the Bank of England on stablecoins.
Yes, this could be huge. The BOE put out a new consultation paper, and the headline proposal is a major shift in their stance on backing for sterling stablecoins. Previously, they were insisting on basically 100% cash backing. Very conservative. Now they're proposing to allow issuers to hold up to 60% of the backing assets in short-term UK government bonds, gilts.
Wow, 60%. So instead of holding just zero yield cash, stablecoin issuers in the UK could hold income-generating government debt for more than half their reserves.
Precisely. It completely changes the business model. It makes issuing a regulated stablecoin potentially very profitable, not just a compliance cost.
That sounds like a massive green light, an invitation for regulated financial players to jump into the UK stablecoin market.
It absolutely is. It provides a strong financial incentive, which could really accelerate mainstream adoption over there. Now, to manage the risks, they are proposing some initial holding limits.
Right, I saw that. Something like £20,000 for individuals.
Yes, $20K for individuals and $10 million for businesses proposes temporary limits. It manages the systemic risk, prevents a massive sudden outflow from banks into stablecoins, but still makes them useful for payments.
So managing risk, but clearly signaling they see a future for regulated stablecoins. Okay, so back to the immediate market, this whole risk-on feeling, the shutdown deal. What did it mean for the rest of crypto, beyond Bitcoin? Did we see capital rotating?
Oh, absolutely. The moment risk appetite ticked up and you saw sophisticated money start moving in the altcoin space, looking for specific catalysts. The standout was clearly XRP. It just decoupled, surged maybe 10, 12%. That seemed driven by fundamentals. They released their 2025 roadmap, heavily focused on institutional adoption, plus news about an EVM sidechain for compatibility.
Okay, so a clear narrative there. What about the really high beta stuff? Any crazy moves?
Well, the curtain, DCR, had a massive day, up over 60%, something like 63%. That seemed to be writing two things. A general interest in privacy coins. But it was really kicked off when their official account reposted an old 2018 comment from Cathie Wood praising its governance.
Ha, old news, driving new pumps. Classic.
It happens. We also saw rotation into narratives like DePIN, decentralized physical infrastructure, and AI-related data storage. Filecoin, FIL, got a lot of attention there. And even within privacy, the focus shifted. Monero, XMR seemed to be gaining traction, while Zcash, ZEC, which had moved earlier, started to fade a bit. It shows how quickly capital chases the next hot narrative or technical setup.
Right. The money's getting smarter, or at least faster, at rotating.
Definitely seems that way.
Yeah.
So, okay, pulling all these threads together, what's the final synthesis? I'd say the market's unstable equilibrium, that indecision, it's resolved for now. We have a cautious spot-led rally. The bullish technical is holding that 50-week EM and the macro relief from the shutdown deal. They currently outweigh those bearish on-chain signals, like the LTH selling and the weak new demand. But it's tentative.
Okay, so if you're listening, what are the key things to watch now, like over the next day or two?
Yeah, three critical things. First, can the rally actually break through immediate resistance? Keep an eye on the $106,500 level. A clean break above that would be a strong bullish sign.
Makes sense. What else?
Second, and this is probably the most crucial one, today's ETF flow data for November 10th. We absolutely need to see if that reverses last week's huge outflows. If we see net inflows again, That could really accelerate the rally. That's the validation the market wants.
Right, confirmation that institutions are back buying. And third?
Third, watch the mega whales.
Mhm.
Addresses holding over 10,000 Bitcoin. Are they going to keep selling into this liquidity around 106K, using it as exit liquidity? Or will they pause, letting the rally consolidate and maybe build the base? Their behavior will be key.
Okay, so it feels like this rally is built on hope, doesn't it? Hope that liquidity from the shutdown deal, maybe whispers of tariff dividend checks, can keep soaking up that selling pressure from the long-term holders. Which leads to a final thought. Today, SIBO launched those regulated onshore perpetual futures we talked about. So think about this. Does that new institutional grade tool make it easier for those big players, the whales who are selling, to hedge their positions and maybe continue distributing their coins more effectively at these higher prices? Or does it actually create a sustainable long-term source of dying pressure right here in the U.S. market? Something to chew on.